Hello again. We're down to the last two segments of Module 6. Interesting stuff too, because again, it will affect the balance sheet, it will affect the income statement. So let's take a closer look as we go right away. So we can sell assets. We don't have to keep a 39-year asset or a 5-year asset for 39 years or 5 years. But sometimes we do keep things and the value that they contribute to what we do diminishes. It's called an impairment. We need to, as soon as we know, record that and adjust the books to show that. And finally, restructuring activities happen all the time. And there are charges associated with restructuring that are expensed right away that are shown on an income statement. So let's explain some of those terms and watch how this works in action. So we sell an asset. Remember we talked about the net book value? We talked about looking at a $100,000 asset, the equipment we looked at before, if you remember. And I'm going to go back to our whiteboard. We had a $100,000 asset, equipment, 100K. And let's say we kept it beyond the 5 years. We're in year 8. And we said it still has a salvage value. We had accumulated depreciation of 90,000. Which yielded net book value or net equipment value, 10,000. And then you sell the thing. Well, it's got $10,000 on the books. We got to clear out the 90,000 accumulated depreciation. We got to clear out the $100,000 in equipment. And if we sold it for 10,000, we got 10,000 cash, and our assets drop 10,000. One asset up cash, one asset down equipment, 10,000. Net effect on assets is 0. No gain or loss. But what happens if we sold it for $20,000? Okay, well, from the looks of that, you say, well, it's 10,000 more than the 10,000 we had all there, which is correct. So we probably had a 10,000 gain. We got 20,000 in cash. We took away 10,000 worth of book value stuff. Equipment goes away, accumulated depreciation goes away, got rid of equipment. I got a 10,000 increase in assets. I've got to balance that somewhere with another decrease of assets or an increase in liabilities or increase in equity. And the short answer, it's an increase in equity. Our retained earnings, we have a gain of 10,000 that washes through to retained earnings, which increases our equity of $10,000. So we'll go ahead and go back to our original show and tell. So we've got our net book value, cost less accumulated depreciation, which we just did. Asset is sold, both the acquisition cost and related accumulated depreciation are removed, and any gain or loss is reported in income from continuing operations. And so that's the equipment that was sold. So if we look at that, we jump over to impairments. Sometimes market value of property, plant, and equipment asset decreases. So we're saying, wait a minute, I thought you told me market value and asset value do not relate, do not compute. Well, sometimes if we have something that's permanently affected, and let's take that CAT scan machine in a hospital situation, maybe that $2 million machine that we bought that used to take 8 employees and $100,000 a year in electricity costs now takes 2 employees and $10,000 a year electricity costs. Is that machine impaired? Well, it still works for us. It still can, we got 8 people thrown at it. And we got, $100,000 in utilities, but we may want to replace that machine. We can save $90,000 a year just in electricity and 6 salaries. That's pretty substantial. Who wants to buy this machine? It's a great machine. It works perfectly, but it takes 8 people to run it and $100,000 in electricity. Well, maybe it's not worth what it used to be. So we have a machine that has impaired. It's not going to produce the value, and we probably would get rid of it. But while we have it, we have to record the impairment. Because if somebody bought that hospital or that medical practice, they say, oh, I got a $2 million machine. We depreciated it for 2 years. Still must be worth 1.6 or 1.5 million. And reality is it's worth a lot less. So we need to go in and we need to account for that. So some of undiscounted expected cash flows, we use a cash flow model to do that. And that's the monthly or annual cash flows, and discount it to today. And we will say it's impaired but the expected cash flow is less than the current book value. So we do have to take into some market considerations. Permanently impaired, not temporarily, but permanent. And we have to write it off and take a loss. So the equipment goes down. When the equipment goes down, we take a loss on our income statement. Our net income goes down. Our equity, our retained earnings goes down. So we're in balance. Our assets have gone down and our equity has gone down. Let's look at restructuring costs. So we have a lot of times that things change. Restructurings are pretty common. It's not like, well, I restructure every 20 or 30 years, whether I need it or not. No, every couple of years, things are going to happen, and we need to account for that. So why do we restructure? Poor performance. Things aren't going well. We need to lay off some folks. We need to reorganize. Maybe our debt is rising, and shareholders, they want to return, and they want us to be more efficient and effective. So what do we do to record restructuring? Well, we're making decisions about business segments. Maybe we're getting out of this business. General Electric is dumping a lot of their businesses. They're focusing on other things. They used to be a conglomerate in all kinds of areas, and they spin stuff off. Even IBM spun off their microcomputers to Lenovo, the Chinese company. So all the IBM PCs, laptops, computers were spun off. They used the name for a while, and now they're all Lenovo. We're selling major assets. Okay, so we cut back our staff. Now we can cut back our buildings. We don't have to maintain as much, insure as much, pay property taxes as much, downsize the workforce, as I said, layoffs before, and reconfiguring of debt. So maybe the interest rates are more favorable, although right now they seem to be becoming more unfavorable. But ultimately, goal of restructuring is to positively impact the bottom line and the long-term performance. So this is a long-term play. So that's, if I ever asked you a question, does the price of a stock of a company go down or up if they lay off 10% of their workforce? If they laid off 10% of their workforce, it either means they're in trouble and they're just trying to consolidate and save money. Maybe they'll lay off another 10% 6 months from now, or they're just becoming more efficient and they're going to have record profits. So the answer is it depends. If you think that layoff is going to enhance their financial picture, the stock goes up. If you think those layoffs are going to tarnish the reputation as well as the financials, price is going to go down. Yeah, but sometimes it's a sign of inefficiencies, or sometimes it's a sign of other failures. How do we disclose? Well, we got to report net of tax what the heck is going on. So we have separate line items on the income statement and a footnote. We put restructuring on the income statement and accrue restructuring liabilities, and there's a formal plan to do that by the board of directors. 3 components: employee severance and or relocation costs. So we might be closing our St. Cloud division. That's going to take some costs to get rid of that and to move employees or to let people know what's going on. We have asset write-downs that we're not going to be able to use the assets to the full extent. They're not going to be able to take full advantage of what we thought the asset was worth because we are restructuring. And then there are other costs associated with restructuring. So what's this about employee severance? A week for every year of service. Okay, you get your salary, or sometimes 2. Or we would agree to relocate. So we like what you're doing, but you got to move if you want to stay with us. And then you make the decision whether we stay or go. You have to estimate the total cost of terminating or relocating those employees and report that estimated cost as an expense and a liability balances. So liabilities are up and profits are down. So liabilities go up and equity goes down because we increase our expenses, which reduces net income. Reduced net income goes into retained earnings, our equity goes down. And subsequent payments to employees reduce the restructuring accrual, the liability on the balance sheet where I write the checks. 2 more slides to go on this. So asset write-downs. We're usually closing a facility or getting rid of a facility. And we might have to write down assets if the fair market value of the assets is less than the book value. Fair market isn't, we're not as impaired, but impairments say our fair market value is below the book value, we get write-offs. So restructuring write-downs can involve long-term assets, property, plant, equipment, intangibles. Goodwill is normally not over amortized. but we may have to impair the goodwill and pull it down. And then inventories. There is no cash flow effect on the write-down unless the write-down has tax consequences. So we're not writing a check. We're not paying out of pocket right now. Where we have those costs incurred, there is no cash flow that shows up as part of the books. So as a restructuring here, they have the balance. This is the details that you would find in the footnote. They added a total of $782 million in restructuring liability, and they record amount of restructuring expense on the income statement. And then reduced liability for employee termination costs and asset impairment charges. So they had an ending balance that was reflected on the financials to go with that. And they have the charges to go with that. So that's where restructuring kicks in and what restructuring is all about. So hopefully that gives you an idea, gives you some insight, and gives you hope that you can read the footnotes and actually make sense of them the more we do this.